Hey everyone, welcome back to Lunch of the Market. We're going to give you a quick rundown today of today's trading action. Netflix is obviously the big story. We came into the day with long at put butterfly. We were hoping for this morning's volatility and the massive downdraft that we saw in the open to kind of be the end of it for the day, kind of a one-day reaction. Turns out that Joe Terranova had been fantastic. Hopefully he applied his short, or he bought some puts on today's opening action because the stock went from basically down $15-16 to down $22-23. So what we have done is initially we took a put butterfly, we rolled the top strike down to the bottom strike. That left us basically short some put spreads in which we had already taken in. If you just look at the structure of just those short put spreads, we're up about 60% on that trade. We are strongly considering taking that trade off today. What we are going to do for right now to protect ourselves is to go out and buy a put butterfly out in June. We're going to buy a 230, 215, 200 put butterfly. So it's a $15 wide wing, I guess you could say, right? $15 wide wings. So you buy 5 of these 230s, you buy 5 of the 200 puts. You've got 2 puts that are long, and then you sell 10 of the 215 puts, and then that basically helps fund your purchase. So I think we paid $2.40. Actually, we may have only paid $1.40. It took 1,200 divided by 5 butterflies. Yeah, $2.40 is what we paid for the butterfly. So at full profit, ideally Netflix would be at $2.15, and if Netflix is at $2.15, then you're talking about the top wing of the butterfly being worth $15. So we're essentially going to pay $2.40 for, what could be potentially a $15 wing. That is a massive, massive gain for the capital that's at risk. Obviously, your worst case scenario on your butterfly is no profit, meaning it blows all the way through both strikes. This is worth 15 and then this is worth 15, and so because you're long this 15 and short this 15, essentially the max risk on the butterfly is what you paid for the butterfly, or $240 per butterfly. So it's a really, really, really low risk way to kind of play a bearish bent on Netflix. So we're going to use that to protect our May short put spreads. So we are left with those, just 10 of the May short put spreads, because we went into May long a put butterfly. So by rolling that top strike down, we went from long 5 butterflies to 10 short put spreads. So we're going to keep that trade on because 215 is that level where we begin to see our profits go away. But then on our long put butterfly out in June, if it gets down to 215, then we're at completely full profit in terms of the long put spread that's protecting us that's out in June. The reason we like to do the butterflies out to the next month is because we need a little time for the story to play out. The put butterfly is one of the lower probability trades in terms of like getting it just right, meaning ideally your stock finishes just above the strike where you're short in the middle of the butterfly. In this case, it's 215. So there's not a huge margin for being wrong, I guess you could say. The other thing that you could do on the butterfly to make it more likely that you're right is just to increase the wings of the butterfly. So you could do a 230, 200, 270 170 put butterfly. That would be a really interesting put butterfly. We might actually have to look at pricing that out. That would give you a ton of coverage. When putting on a butterfly, you want to consider the most recent highs, because when the stock finally stops declining, it will have declined from the most recent high all the way down to wherever it stops. In the case of a put butterfly that's 230 by 200 by 170, you would have seen a $55 decline in the price of stock, or about 20%. We'll see. On last night's Mad Money, Jim said go ahead and wait a couple days and then buy on the 3rd or 4th day, buy Netflix back again after the pullback. So far, the uptrend is not in jeopardy Probably pulling back to a moving average. I'd have to take a look at our different moving averages to see where the stock looks like it's about right now. But the uptrend is certainly not broken as of this point right now, which is like Tuesday at 1:40 p.m. As of right now, the uptrend is still intact. They would have to do a whole lot more damage on Netflix to get the uptrend to be broken. So that's where we're at in today's trading action. So we're putting on some put butterflies in June. We definitely want some protection. We actually took off. We had a risk reversal trade in which we were short the 155 put, long the 170 call, and then short the 200 call above that. We actually took that off up 58%. There's really no reason, at least at this point from where we stand right now, to continue to try to squeeze out the remainder of that trade. We took it off for $20.15. We paid a whole lot less for the trade than that. And so there's really no reason to continue to kind of press our luck. Netflix is a high momentum stock. It's a love you, hate you stock. On days that it's up, people love it. On days that it's down like this, a lot of people hate it. And that ratio changes pretty quickly. So there was really no reason to continue to have such a ton of exposure in Netflix because it was our most profitable trade of 2010. I think that's correct. It's usually when I look at an account and I look at the gains since we opened up the account, it's usually number one position is our Netflix position. And so having been so successful on that, we really don't have a whole lot to gain by continuing to take in more money, but we obviously have a lot to lose if we let some of those gains that we currently had slip away just for really nothing, right? It's a piece of paper, it's a stock. For us, it's actually an option, and so we're not married to it. We'll just simply find a cleaner story to make some money. The valuation, of course, is an issue. Competition is constantly coming into the space. Even though the models from the Amazon model is the closest model to the Netflix model in that they're offering you basically a subscription service that just comes with Amazon Prime. The problem with Amazon being a serious competitor is, one, their library is a fraction of that of Netflix. Two, they're not charging you anything for the content. You just get it if you're an Amazon Prime member. And so the reality is either Amazon's going to have to spend a ton of money on acquiring content, which Netflix already owns, and so Netflix is already way out ahead of that, or they're going to have to charge you for the service, and then you're going to have to look at, well, how much is Amazon's service? And certainly if they price it above Netflix, then why would you pay more for less of a service? So I think Amazon's in a really difficult position right now. I think the trade there is to kind of just stay away from Amazon. I think they report today after the close. It's probably a good idea to get a put butterfly on Amazon ahead of earnings. In fact, we might actually just do that just to take a flyer on Amazon ahead of earnings. So we would be bearish on Amazon going into earnings. We are going to put on some bearish trades in Netflix to try and see if we can capture some of this downside move. Otherwise, we've made a ton of money on Netflix. It's been good to us. If it does look like the stock is going to put in a bottom at some point, especially if it approaches 200. If it approaches 200, we're definitely going to look to sell some put spreads, at least for now, using the 170 target from the analyst that was on Fast Money Halftime as the price target, and we'll try to stay below that 170, and we'll just sell put spreads below that and kind of wait to see what happens on the next quarter. Going into each quarter, we'll do what we did this quarter, that's be long a put butterfly. We'll make the width of the wings basically how big we think the move could be. Today's move has been absolutely ginormous to the downside. Stock's down $23 a share. That is a very large move. It's basically a 10% down move in the stock that was $250 just yesterday or the day before. So get bearish. If you got high flyers going into earnings, please put on a put butterfly to protect that thing. If you don't mind spending the money, do an outright put spread. That's certainly a great way to capture that downside risk and make it a little bit cheaper. And that's where we stand. All right, thanks so much for joining us today on Lunch of the Market. Be careful out there with Netflix. We're still really not in a mode or a mood to put on new positions. We've really just been taking off positions, raising cash, and protecting our gains. So that's the game that we're going to be in. We're going to stay in until the market tells us otherwise. Thanks for joining us again on today's Lunch of the Market. Don't forget, if you live in North Carolina, especially Winston-Salem, sign up for the class that we're going to be teaching. It's a 10-week class for under $500 for the class. class. That's unbelievable pricing. Usually you have to pay like $7,000 to $15,000 for a weekend, and you learn absolutely nothing. This is a 10-week class. We're going to teach you a ton of stuff, a ton of trades, a bunch of trade repair, and how to use options. If you don't know anything at all, please sign up for the class. We're going to start absolutely from the beginning, and then work our way into the various different strategies. It's great. It's right in Winston-Salem. It's going to be at the Piedmont Club, which is a fantastic place. And then also, don't forget America's Favorite Traders. You've got James Altucher, Jared Levy, Dan Fitzpatrick, Pete Najarian, and Zachary Carabell, all on Season 2. They're all available. Search on iTunes for America's Favorite Traders, or just go to our website, look for the blue button for America's Favorite Traders. Click there, and you can listen live right on the website. All of that's completely for free. Thanks for joining us again today. Have a great day, and we will see you tomorrow.